Buying a property in a company name has become very popular in the recent years, and according to a broker's survey, nearly 80% of mortgage applications are now for limited companies. This trend started after changes to the treatment of mortgage interest was announced in 2015 budget. However, many still cannot decide whether to buy a property in their own name or a company name. Hi everyone, this is Ash Ajaz, and in today's episode I will be discussing the pros and cons of buying a property in a company name. Let's get started. When you own a property in your name, the profits you make from the rent is added to your other earnings, such as your job, and taxed as income tax. However, when you hold a property in a company name, you will pay corporation tax on the profits. The rate of corporation tax is around half of a higher rate tax, which can mean a huge saving. You will be liable for tax on dividends. However, you can do one of the following: time dividends for maximum tax efficiency, distribute them within family members who are lower rate taxpayers, and leave the profits rolling up in the business to buy your next investment property. As of April 2020, you can no longer claim mortgage interest as an expense if you own your investment property in your own name. However, if the property is in a company name, you can continue to claim. Owning the property in company name gives you more options when planning for inheritance tax. You can take advantage of trust structures, different types of shares, and other methods. It is best to speak to a specialist tax advisor who can guide you based on your circumstances. If you are planning to live off of the rent from your property, then you will have to take the money out as dividends, which will be taxed. This will be in addition to the corporation tax you have to pay. It is advisable to run the figures to work out the best option for you based on your circumstances. Mortgages for companies used to be limited, expensive, and had a lower borrowing limit. However, this has changed in the recent years. For a company mortgage, you may need to provide a personal guarantee, and your personal credit history will be assessed. It is best to consult a mortgage broker who can search the market for you to find you the best solution. When owning a property in a company name, there are additional costs to consider. These include higher accountancy fees, tax advisory fees, lender's fees, and broker fees. Your decision to buying a property in a company name depends on the following key factors: your tax bracket, do you want to live off the rent, will you take a mortgage, and your exit plan to either sell the property or pass the property on to your family. Before making a decision, you should speak to your accountant or a tax advisor who will advise you based on your circumstances. So everyone, hope you found today's episode useful and informational. Please be sure to check out some of the other helpful videos on this channel. Please subscribe to this channel, and thank you so much for watching.